and welcome to a brand new episode of your favorite weekend show, Smart Money. Now, with the markets once again less than 3% away from all-time highs and earnings season now almost behind us, we speak to Gautam Duggad, Head of Research at Motilal Oswal, on how you should approach the market now, how valuations are stacked up, and whether India is still a preferred bet in the emerging market space. Gautam, thank you so much for being with us here in the studio. You know, that is our, that's the perennial problem, right? I mean, it's a good problem to have. Markets almost at all-time highs. Should I get in now? Should I be a bit cautious? But at this juncture, just to set the tone, how are you feeling about the market?
So, Sonia, market has been good, but it's been led by earnings. When we say markets are at all-time high, we forget that earnings are also at all-time high. Let me give you a data point. NSE 500 profit pool 3 years back was 5 lakh crores. We ended FY23 at 11 lakh crores. So that's about 28% CAGR. And NSE 500 market cap CAGR is 31%. Even for Nifty, the 3-year profit CAGR is 22% and a market cap CAGR is somewhere about 27%. So while markets are at all-time high, the corporate earnings are also at all-time high. The GDP is at a new high. And next 2 years also we are looking at around 15-16% kind of a corporate earnings CAGR. So market over a period of time has broadly respected the underlying corporate earnings, give or take few percentage points or few months here or there. When the markets were flattish for almost 7-8 years, so FY14 to FY20, if you look at the earnings compounding, it was hardly 5-6%. And markets also gave you similar sort of a compounding. So over a long period of time, broadly the market has respected the underlying corporate earnings. And that is where we are seeing a lot of buoyancy. Even this quarter, as we speak, is about to come to an end in a few days. The earnings have been ahead of expectations for any set of aggregates. You take Nifty, you take our broader coverage universe, X this, X OMC, any sort of aggregate you look at, the earnings have been better than estimates. And we have seen a marginal earnings upgrade now. So while markets have done well, it's led by earnings, and valuations, in my view, for large cap at least, is still very reasonable.
So earnings are generally the bedrock of every bull market rally, right? And it's been good, you said. You said the profit pool of the Nifty has gone up from 5 lakh crores 5 years ago to 11 lakh crores right
3
now.
3 years, that is for NSE 500.
For
5
NSE
to 11 lakh crores.
Okay, so we're sitting at 11 lakh crores in terms of a profit pool right now for NSE 500. How much do you think it can go up by, say, over the next 2 to 3 years? What are you looking at? And which are the sectors that can lead it up?
So, Sonia, our estimate for Nifty for next 2 years is a CAGR of about 17%, which is basically distributed like this. FY24, we are expecting a 20% earnings CAGR, and FY25 about 15% growth. So that basically sums up 16-17% growth. It will be led by 2-3 very important domestic cyclical sectors. One is financials, which already had a very stellar run in terms of profitability over the last 5 years, and profits have been up 5 times in 5 years. Over the next 2 years, in financials profit pool, we are expecting about 20% compounding. Auto, we are expecting to almost double the profit pool in the next 2 years. And then we have consumer and pharma growing somewhere about 14-16%, and IT at about 10-12%. So these are the basic large contribution of the index sectors which are driving the earnings over the next 2 years. Where we find earnings slightly subdued is in the global cyclical pack, because that is where the global growth is still a bit shaky. Commodity prices have still not come back to their earlier highs. And for those sectors, the underlying commodity prices matter more. Whereas in domestic cyclical and say defensives, which form roughly 65-70% of the total profit pool, we think the underlying macros as well as the overall environment on demand front is picking up quite well, and we expect it to sustain.
Okay, I want to talk a little bit more about the macros and the micros, but at the end of the day, all of this boils down to valuations as well, right? What's your view? How are the valuations stacked up now compared to our own historic averages and also compared to our global peers? Because there is one narrative that China is now looking more attractive than India, so money could move into China. You don't buy that argument?
No, I don't buy that argument, Sonia, because 10 years back also China looked attractive. Look at the returns. 10 years compounding for MSCI emerging market is flat. MSCI China is marginally flat to negative, whereas India is given about 11% CAGR, despite being expensive to begin with. 5 years compounding, MSCI China again negative, MSCI emerging market flattish to negative, India about 10% compounding. In fact, if you look at the last 2, 3, 5 years performance, Indian markets have been amongst the best performers. I'm not looking at CY23 YTD because some of the other markets which had fallen in CY22, they've rebounded. So India is not right there at the top of the league in CY23. But if you look at the last 2 years of compounding, 3 years, 5 years, 10 years, we are right up there. Even on a 10-year basis, barring, I think, S&P 500, most of the markets have lagged India. So I don't buy that argument because India has always been expensive for a reason, right? Our corporate earnings are very different than the rest of the markets. Our ROEs are picking up, and there is a good macro policy momentum in our support. As far as valuations are concerned, I think Nifty is bang in line with long period average right now. We're trading at about 19.5, 20 band. 3 months later, you will start looking at FY25, where the valuations will become even more supportive at about 17.5 to 18 times. Right? So from a large cap point of view, Nifty point of view, I don't think valuations are giving you any scare. The real problem is in mid cap and small cap, in pockets of mid cap, small cap. Because mid cap at an index level is now trading at a premium, and small cap is still at a discount. But within small cap index, the constituents where there is a lot of interest, those stocks are obviously trading at a much higher premium versus their historical past. So there are pockets where valuations has really gone up. Stock prices have doubled, tripled. For example, in industrials, I was looking at the data. 3 years back, the top 100 industrials company of India had a combined market cap of 7 lakh crores. Today, it is 21 lakh crores. And if you look at the same data for companies below 25,000 crore market cap, the market caps have gone up 5, 6, 10 times. Right? So a lot of the buoyancy in earnings is more than factored in some pockets of the market, especially mid caps and small caps.
Absolutely. I take that point completely, especially, I mean, look at spaces like defense, right?
Yeah.
The kind of up move that these stocks have seen, 100%, 200% in the last 1 year or so. So let's talk about that. Which are the sectors that you like where there is an upcycle after a long lull period, right?
Yeah.
Because we've spoken about that ad nauseum. There's autos, there's real estate. These sectors have come back after a very long sort of dead period. But where is there both valuation and growth potential now?
So as far as cyclicality is concerned, there are 5 sectors where the upcycle is happening after a very long time, as you rightly mentioned. Look at real estate. After 10 years, the sector has started breathing again. Second, you look at auto. For 5 years, the profit went nowhere. Between, say, FY18 to FY23, the profit pool of auto was flat, when banking profit pool went to 5x. And now we're expecting auto profit pool to double. 3 quarters in a row, we have seen earnings upgrade in auto. In fact, in this quarter also, the best performing sector is auto, where we have seen by and large upgrades across our coverage universe in auto. Then I would look at something like hotels. That sector has also had seen a very long stagnation. For 10 years, the EBITDA of Indian hotels was almost flat from FY8 to 18 or FY19. But now we are looking at 35% margin for companies like Indian Hotel. And other companies in the hotel space are also doing quite well. Similarly, you have sectors like, say, hospitals. I don't know when was the last time there was a cycle in hospitals. And suddenly there are too many options to play in that sector where earnings are coming up thick and fast. So basically, broadly, all the domestic cyclical oriented sectors, financials, everyone knows and everyone talks about it endlessly. But then there are other smaller sectors which have relatively lesser weighted index. They are having their own mini upcycle right now.
Okay.
Industrials, we already spoke about how the profits and order books are growing. But in that case, you have seen market caps already jumping multiple times in the last 2-3 years.
So you spoke about autos, you spoke about real estate coming back after a long time, hotel companies as well. Here, what do? Do you stick to the large cap guys because all of these stocks have rallied substantially, whether it's M&M, Tata Motors, Indian Hotels, or do you now find value beneath the surface, right? I mean, in the broader markets. And if yes, what are the 2 or 3 top ideas here in these sectors that are coming back after a long time?
So, Sonia, there is no compulsion to stick to any particular market cap segment. You have to stick to a company where their visibility of earnings growth is strong. So be it small cap, mid cap or large cap, it doesn't matter. For example, in automobiles or Autocom, we started covering Craftsman about 6-7 months back. The stock is up 40-50% from there. But next 2 years, we are looking at compounding earnings of 35% plus. So P is still 20 times. There are many such ideas. In fact, we are big time overweight on auto. We have large caps like M&M also in our model portfolio. We have mid caps like Ashok Leyland, Bharat Forge also, and small caps like Craftsman also. Similarly, consumer discretionary, it's a big ocean of sectors there. It subsumes many subsectors. You have hotels, you have footwear, apparel, jewelry. We have a huge overweight right now going on consumption in our model portfolio. So we have Metro, we have Titan, Indian Hotels, we spoke about Kajaria Ceramics, Zomato we had added a month and a half back. We are positive selectively on QSR space also. So after financials, I would think our biggest overweight right now is in consumption, and within that, consumer discretionary. The only sectors we are right now neutralish is IT and pharma, and underweight on global cyclicals. Otherwise, financials, and within that, our preference is towards NBFCs. So financials, consumption, auto, and select industrials is where broadly my overweight positions are concentrated in model portfolio.
You know, I want to talk to you about financials because that's a space that has been under pressure. Since July, the index, the Nifty Bank is down almost 4%. But what we're going to do is we're going to take a quick commercial break and come back with lots more on Smart Money. Do stay tuned in.